Hello, and welcome to the Opes Wealth Management fourth quarter 2022 markets discussion. I'm Aaron Whalen, and with me today are Mark Duvall, our co-president and chief investment officer, and Louis Odette, our senior client portfolio manager. Our typical format in these conversations is covering, hitting upon a number of geopolitical, macroeconomic, corporate factors that we see influencing markets. Right now we have one dominant factor, and that's inflation. And of course, the Fed's prescription or remedy to try to bring that down. Mark, could you start with a little backdrop of why this is a big deal in terms of inflation and interest rate policy, how it impacts clients?
Yeah, I mean, the clearest place is just on increasing borrowing costs for all individuals and companies that are all, and governments that are all borrowing. So three areas that I'll touch on. The first is on mortgage rates. Somebody going out to buy a home and get financing right now is facing a 7% mortgage. That's a lot higher than it was as recently as the beginning of the year or a year ago. When you look at corporations, corporate spreads have widened, and combined with the base increase in interest rates, it means that they're having higher financing costs for their operations. And then when you look at the government, we had the 10-year Treasury at 0.7% a couple of years ago, just coming out of the pandemic, and now it's between 3.5% and 4%, depending upon what day you're looking at. And so the impact on the budget for how the government's going to be spending its money is going to be dramatically different going forward. Another impact has been on stocks, and it's because stocks are valued against the earnings that they're generating today and off into the future. Well, when you discount back those future earnings at a much higher rate, then all of a sudden those future earnings aren't worth quite as much, and so valuations of stocks should come down, and that's in fact what we've seen this year. Finally, I guess I'd say that we've seen interest rates rise faster than we've seen since the late 70s. And we've got a graph that references that inside of our quarterly commentary, but that's certainly been something that's been unusual about this year.
So then let's hone in a little bit more on Fed policy. And there's very bifurcated opinions in terms of, are they doing the right thing? Are they doing enough? Or are they doing too much? And as an example, you've got Jeremy Siegel, well-respected Wharton economics professor, who's borderline hysterical that the Fed is being way too active in monetary policy. On the other side, you have Larry Summers, Harvard economic professor, former Treasury Secretary, two very well-qualified people, let me put it that way. Needless to say, the Fed is walking a tightrope. What is our view, Louis, on or assessment of what we're seeing?
I think the reason there's such a debate around this topic is because there's a delay between when the Fed takes action and when that shows up in the economy. And that delay has sort of three components to it. One, you need loans to reset in the first place. Two, you need borrowers to realize that that's happened and adjust their behavior. And then thirdly, you need to compile and report that data. So what the Fed's trying to do here is essentially akin to driving a car by looking in the rearview mirror. So very tough task, and so my heart goes out to them. But at the same time, if you do force me to say which side should they err on, I think they're doing the right thing in being aggressive, being hawkish, and increasing interest rates quickly because they were kind of behind the eight ball on the whole inflation thing and need to catch up. And so they're balancing two risks. One, if they don't go quickly enough or high enough, then they risk ending up in a 70s-like situation where it took three different inflation and interest rate cycles to finally get a lid on things. On the other hand, if they do go too aggressive, then they risk putting the economy into a deep recession and doing irreparable damage to it. Between those two risks, I'm sort of inclined to err on the side of the latter because they can always reduce rates, and a lot of the damage that they might do can be undone by doing that. That being said, as I mentioned, very difficult task, and we just won't know the right answer until that data starts coming in.
And so much of the inflation conversation has been focused on Fed policy, which you just addressed, and impact on demand. But prices, of course, are set by not just demand, but as well as supply, which is much more opaque and more difficult to speak to. But again, I'll put you on the spot, Louis. Share any thoughts you have in terms of what we see there.
Yeah, so I think it's probably a tough topic to generalize about and might be more useful to just kind of go through a few case studies, right? So on the one hand, you have energy, geopolitics, environmental concerns, all big factors there. We pretty much know that story. On the other hand, you have business inventories, right? And so a couple things going on there. You have supply chain disruptions, as well as shifting consumer preferences as the economy reopens and people are able to get out and do other things. So it's sort of a heartbreaking scenario where the bike shop has been trying to get those bikes on the shelves for a year and a half. They've finally arrived, but then they have to discount them because everybody's gone back to the gym. And similarly, the housing market, right? You have a couple things at work there. One, borrowing costs, and two, construction costs. And so if you're an existing homeowner, you don't want to move if you've locked in a low rate during the pandemic, because your interest rate would probably double on a new loan. And at the same time, it's very expensive to build new housing. So in both cases, your supply has really been suppressed. And so, that's the thing. It's a difficult topic to generalize about, very idiosyncratic overall, but still very important.
So Mark, could you try to tie all this together in terms of client portfolios, what we've seen in terms of attribution, what we see going forward in terms of potential changes?
Yeah, when we look at the value versus growth aspects within our portfolio, we've had an overweight in value stocks, and that's been valuable because they were down around 18% year to date versus the 31% that growth stocks have been down. When we look at US versus non-US, interestingly, non-US stocks in their local currency have outperformed US stocks by 8% this year. But because the dollar has risen so much, they've actually underperformed by 4% relative to US stocks in US dollar terms. Now, how long the US dollar will continue to rise, that's a separate story, and it's getting up near the best levels that it's had over the last 40 years. Then when we look at the bond market, that's been the area that's been hit the most by rising interest rates. US bonds are down almost mid-teen numbers, but because of the currency, non-US bonds, which we've been underweight, have been down closer to mid-20s level, more akin to many of the stock markets. And then finally, our alternatives, they've had varying but much more stable overall performance than either the stock or bond markets have this year. They've definitely been a stabilizing force for portfolios this year, and we anticipate maintaining those holdings and looking for opportunities where we can to continue to add value.
Well, I appreciate you both sharing your perspective, and thank you for everyone that joined us. We very much look forward to our meetings and conversations with you in the coming weeks and months.